For more on today's economic data, let's bring in Bank of America Merrill Lynch senior U.S. economist Michelle Meyer. She joins us now from her New York office. Michelle, thank you so much for joining us. Happy Friday to you. So you had these two reports today that seem to paint a very different picture. On the one hand, the retail sales report coming in better than expected. On the other hand, that consumer confidence report really having a dismal reading. How do you take those two together?
I think what it shows you, part of it is a timing difference. The retail sales report was for July. Consumer sentiment was for early August, and over the past 2 weeks, we've seen a huge sell-off in the stock market. We've seen a big confidence hit. So it could just be a timing effect where the August retail sales report, maybe the September retail sales report, looks a little bit softer as consumers pull back under that confidence shock.
And of course, one of the things that's hit them in that August report has been what's been going on in the markets. I'm looking at your note that you guys put out on August 4th, so really before this current pullback. And even in this note, you said there was a 35% chance of a recession in the next year. You said there's a 10% chance we're there already, barring any kind of shocks. Did we just get the shock in terms of what happened in the markets?
I don't think just quite yet. It would have to prove to be a persistent sell-off in order for us to feel like it could be that final shock which would push us into a recession. The economy is still expanding. The economy also, you have to remember, is very lean. Businesses only added back a small portion of the considerable amount of workers that they cut during the recession. They've only added back some of the inventory. So they're running lean and mean right now, which means that you need to see a pretty big shock and a sustained one in order for businesses to cut considerably more from here and to push us into that recession.
I'm curious what a shock could look like. So it could be a sustained sell-off in stocks, for example.
Yep.
What else could happen? Would a worsening in the European situation be enough to push us here into recession?
Well, the challenge with a shock is that by definition, they're unforeseen, they're unpredictable. So it's hard for us to say what it could be. It could be any type of exogenous shock. If you remember back to the beginning of the year, we had two such external shocks. We had a big jump in oil prices as a result of the unrest in the Middle East. We also had a natural disaster in Japan, which hurt global supply chains. So those two, anything similar to that, of course, would be considered an exogenous shock. But you could also have more of an internal shock in the sense of something in Europe escalating or another policy disruption, whether it be in the U.S. or in Europe. If that feeds on itself, creates a negative feedback with the economy, that could be something that would tip us into recession as well.
So, Michelle, 35% chance of recession in the next year. That's not, I mean, that's not inconsequential. What are the indicators that you're looking at to point you to whether we are seeing it? Because as we know, NBER, which dates recessions, does so typically well after the fact.
Yeah, and that's why you can't look at the NBER indicators, because those are coincident numbers. By the time those turn, we would have been well into a recession. So you want to look at the leading indicators. That includes initial jobless claims, and in the last week, jobless claims actually held close to that 400 level. So we haven't yet seen that spike in claims. You also want to look at surveys, and here the story is a little bit mixed, because if you look at consumer sentiment surveys, certainly what we saw this morning, there was a sharp decline in sentiment, which would be indicative of the economy falling into recession if that decline in sentiment continues. And I'd also look to the ISM numbers, the manufacturing surveys. Tends to be the most cyclical part of the economy, so if you have the ISM surveys dip below 50 into recessionary territory and remain there, also I would say the hard data is going to start to crack lower as well.
All right, we'll be watching all of those numbers and all the data as it comes out in recent weeks, and I'm sure we'll be checking back in with you. Thank you so much, Michelle. Michelle Meyer, Bank of America Merrill Lynch, senior U.S. economist, giving us her view on the economy. I got to say it again, 35% chance of recession in the next year.